What is up, everybody? Today is Thursday, May 29th. I almost forgot the date there. It is Thursday, May 29th, and today was a great day in the market. The model that I teach came out multiple times today. So let's review the price action from this morning and afternoon. As you can see here, these two candles pretty much were the New York AM session, and then the PM session we kind of just consolidated for the most part. But the biggest thing that I was watching this morning was this 4-hour fair value gap that we had right here. As you can see, right, we've been in an uptrend for quite some time. We retraced and now we came in to put in a higher high, and it seemed like price was stalling here to put in a higher low once again. Now, when the way we verify that we're going to continue going lower is if we end up getting an invalidation of a higher time frame fair value gap. So the biggest one that I was watching was this 4-hour fair value gap, which, as you can see, after 10 o'clock, we did get that. And same thing with the hourly time frame. You can see that at 10 o'clock, we invalidated both this bullish fair value gap right there and that one right there. So it left us with little to no obstacles to this swing low right here, which was my draw on liquidity for the day. So let's mark that out. Same thing on the 15-minute time frame. You could see that we're now in this sell side curve where we're selling off here, respecting bearish PD arrays and disrespecting bullish PD arrays. Overall, there was no reason to think that we were going to go higher just based off of the way price action was moving, right? That 10 o'clock invalidation of those two fair value gaps was super important. And if you look here on the 15-minute time frame, we have bearish structure happening as well. You can see lower lows, lower highs, and then here we put in a higher low. So we'll see what tomorrow brings for us. But for now, right, we came in with a bearish bias after 10 o'clock. That's the key point here that I want to really, hone in on, because without that, you were going to try to take longs and you would have gotten stopped out at every single occasion. So the trade that I took was actually this first one here in the New York AM2, which is the 950 macro. I waited for the 10 o'clock open just to see where we would end up. I saw that we had that 4-hour invalidation. It was 10 o'clock, and I noticed that it was consolidating in this area. It had taken out this bullish fair value gap right there. So that is the entry model. It took out that 1 minute bullish. It became an inversion fair value gap. There was a bearish fair value gap sitting right above that as well, as you can see right there. So with that invalidation, I actually got filled in lower because I thought about it for a little bit too much. I was like, I don't know, maybe I should not take it, wait for the next macro. But I was like, you know what? I'm just going to take it. It looks really good. Put my stop above the swing high. And as you can see, this hit a very nice 1 to 2 very quick. I actually took off my gain right here because I decided, you know what? I don't want to be greedy. I'm sitting well above a 1 to 1.5 at that point. I just want to end up green, right? There was no reason for me to want to hold out for longer or take off at least some profit. I also had to get going. I didn't have much time on the charts today. I was very busy. And so this was the only macro I could trade, and I took that, walked away nicely green on the day. I'm still going lighter risk, so if you guys go to my Instagram page, you'll see that my gains aren't as much as they have been because I've been going half risk these last couple of days, especially last week and this week, just because of how the market's been moving, right? I want to start seeing more consistent setups, high probability setups, and once that happens and I see it more consistently, which I'm starting to this week, then I'll start going full on risk again. So as of right now, I'm only half risk, which is about $250 per trade, and then full risk is $500 per trade. So this trade was a great one. Now, as you can see here, the next bearish setup that we would have wanted, especially because we rejected the 10 o'clock open. So if we're expecting to put in a bearish 4-hour candle, you don't want to see price moving back above that 10 o'clock open. That is a major level that you should always keep an eye on, seeing as to how price reacts to it. So you can see here, we reject off of that. Here is a bullish fair value gap on this price leg up. We invalidate that. You enter in, stop above the swing high because there's no reason why it should come back up if it is truly going to sell off. This one took a little bit, right? But in the end, boom, smacked that very quickly to that draw on liquidity. And then the New York lunch macro, we had yet to hit that, and we're still continuing to sell off here is another bullish fair value gap. So let me zoom in on that so you guys can see it. So the bullish fair value gap was right there. Gets invalidated with this candle. We actually swept this high, or these highs right here, and then started to sell off. And that was, as soon as you entered, literally a 4-minute trade, and it hit a 1 to 3.5. So the model appeared 3 times, 3 bearish setups, specifically only during the macros. And so that's something that I want to point out. If you're not using time in your trading model, then you're going to end up taking lower probability setups. The importance of time is so key when it comes to developing a repeatable trading model, because think about it. The chart has a time axis and a price axis. So people always think about price. Oh, now is a good time because price is behaving correctly to the setup that I'm looking for. But if I'm looking to take a short setup here, I end up getting stopped out. But if I waited for the time, which was during the macro, that short setup right there paid out. If I try to take short setups outside of the macro, there was another one right here that goes according to the model that I trade, that got stopped out. That's why ICT always says time, then price. You know, you gotta pay attention to that. You gotta have some kind of an aspect of time in your trading model. So now, once the drawn liquidity was hit, I highly recommend you don't trade anymore, because this was the daily objective, and it was obvious because at this point, you know, it just continued to chop around for the most part. So here, was there any kind of bearish setup? I would say yes, mechanically there is, but ideally you wouldn't have wanted to take that because it is a very small FEG, like literally probably 1 tick. No, it's not even an FEG. So I lied. There's no setup. There was no setup according to the model that I take. We are still bearish at this point based off of the higher time frame order flow and structure, but we do think we're going to head lower. We failed to take out the low right there and start to push on higher. So then at this point, you could probably expect some kind of a reversal back up. And we do get a bearish fair value gap that gets invalidated right there. And as you can see, price comes back, taps into that, no coincidence, and then starts to rally on higher. Honestly, I don't even know how much this would have paid out. I don't think it would have been a great RR, but we'll see. At most, it hit it hit a 1 to 2. So yeah, great trade, I guess, right at that point, because you know, you try to target areas of liquidity that are areas where price could gravitate towards. But if the area of liquidity is so high up and it's like a 1 to 5, there's no reason why you should be holding that trade all the way to that point. If it's at a 1 to 2, if it's at a 1 to 1.5, take your gains, because they're not promised. All right, the gain means nothing unless you take profit. So hitting a 1 to 2 every single time, even if it hasn't hit the objective yet, is totally okay. And you realize that in my trade setups that I take, I do that a lot. I take my gain off at like 1 to 1.5, a 1 to 2, because I'm looking for consistent gains every single day, because that's what's going to bring longevity to my portfolio. That's what's going to hit me with a higher win rate. That's what's going to keep me in the trading game for the long run. Okay, as long as I'm taking consistent profits, there's no way I could blow up an account. All right, so hopefully you guys ended up green today. Like I said, it was a great day today, and we'll see what tomorrow brings. Peace, guys.